Hello, everyone. Thanks for showing up. I know it's midday for East Coast people, earlier for West Coast people. Um, but I think, if you've got questions, we'll be able to answer them today. I'm Debbie Schwartz, founder of Road to College and Paying for College 101, and I'm here today with Chris Upkarians. He's a co-founder of Juno. And this is truly an AMA. Ask us anything about student loans, changes that might be happening to, or not might, they will be happening to federal loans because of the bill that was passed in Congress in July. And Chris will explain a little bit about Juno, because I think it's worthwhile that people know what they do relative to other lenders. And then we are truly here to answer questions. And the way you can ask a question is in chat, or it's a really small group right now. If you want, you can actually even unmute yourself and ask the question directly. So if whoever is here, if you want to just tell us where you are in the process, meaning is your student going to be moving in, in the next week or two? When is your tuition bill? When is your tuition bill due? And are you in the process of shopping around for loans? And while you guys share that in the chat, I'm going to hand it to Chris to explain a little bit more about Juno and his background and how we're here to help.
Thank you very much for the intro, Debbie, and thank you everybody for being here. I'm Chris, and I'm one of the co-founders of a company called Juno. The short story is 7 years ago, I needed to get loans for my MBA. And one of my classmates and I were comparing notes on which lenders were giving us what rates. We decided to start an experiment to see if we could bundle together a few hundred of our classmates who needed to get loans at the same time and ask different lenders if they would give better rates and terms to our group than we could get on our own. Many of them said yes. We got them to compete against each other. And for the last 7 years, we took what was initially just an experiment and turned it into Juno, which does the same thing, but for a little over 200,000 people now. With that, if you do have any funding needs for this fall term or the spring, Juno has offers available for undergraduate loans that you can find on our site. And we can drop the link in just a moment. You can check your rates without impacting your credit score. And if you find a lower rate from almost anywhere else, then we're able to match that lower rate and give you 3% of the loan amount as a cashback reward. So purpose is not to trust me or anybody who says that they can get you a low rate on loans, but to encourage you to shop around and to see what the lowest rate you can possibly get is, and just give us a chance to match and beat that at the end. With that, as Debbie was mentioning, I'm happy to answer any questions you have about any portion of the financial aid journey. Let's maybe jump into it.
Yeah. Anybody have specific questions? I mean, and I'm kind of curious of the people who have put in information in the chat. Somebody said they have already applied to several lenders, and kind of based on what Chris just said, have you seen, I think that is Stacy, if you want to share, have you seen that you've gotten different rates from the 3 different lenders, and how are you deciding which lender to go with?
This is Stacy.
Hi.
Hi. We applied to 3 different lenders for my daughter that's a sophomore and got really wide-ranging rates and ended up going with Sally Mae, and they had the lowest rate, and that's the lender that we had for her freshman year tuition as well. I did have a question about doing a loan consolidation. Can I do that while she's still in school? And because let me just say, her initial loan is about a 10%. We didn't know anything that we were doing. We didn't have time to get the research done, or didn't make the time, didn't know a lot more that I know now. And then I think the loan that we just got is just about 5%. Um, Obviously much better. We're in a much better position. We had to borrow a lot less this time around. And my other daughter is staying home, so we're not having to borrow other than her own federal student loans. So we don't need to borrow there. But I think that's my biggest question is trying to get her a lower rate on that original loan.
It's a really good question. Let me one quick follow up, and then I'll give you the way that I would think about it. So you mentioned this year you borrowed less than you did last year.
Yes.
So if you had extra room left to be able to borrow for this year, maybe
Dude,
just go
I'm
ahead.
sorry. I'm not sure I understand your question.
So your borrowing limit for this year would have been your cost of attendance minus the other aid that you had already received. And I'm just curious if you had the amount that you borrowed this year, is it a smaller amount because you received a lot of other aid in the form of scholarships or grants or other things? Or did you just not borrow as much and you put more of your savings towards paying for this term?
It was more that the cost was a lot lower. Where my daughter goes, she had to stay in the dorm the first year, and she also had to have the unlimited meal plan. Both were tremendously costly in my mind. And this year, she's staying in a house with a much lower rent, and we're getting her a much lower meal plan. So the costs were dramatically lower.
Understood. Okay, thank you. So here's how I would think about it. Look, this might get a little bit complicated, but I think there's some really interesting learnings and things you may be able to actually do. So in terms of a traditional consolidation, which would say, here's a lender that's going to pay off your old loan and you're going to have one larger new loan at hopefully a lower rate. That's not really something that is available at the moment. Sometimes one lender called Long Road lets you do it, but almost always you're not able to do it with the refinancing companies until your daughter would be in her final semester of school. And the reason they do it that way is because they don't want you to refinance with them and then go borrow a significantly larger amount for the third and fourth year of school, which then increases how much debt you have and makes it riskier for them to get paid back. In theory, that's kind of the logic behind why it's typically forced waiting until the final term. Now, that being said, you actually might have an opportunity here to kind of do what I call a manual consolidation or refinancing. And then this is simply how I would think about it. This year, although the cost is lower, the amount that you are allowed to borrow is probably quite a bit higher than what you are going to borrow. And we can talk a little bit more about whether that is true or not. But based on what I'm hearing, my assumption would be the school would still let you borrow up to what more expensive housing would be on campus and the more expensive meal plan, as well as an amount that they'll estimate for living expenses. What you could do is because you're getting much lower rates this year, borrow a larger amount this year, but then use some of the excess money that you don't need for this year to prepay last year's loan that has a much higher interest rate. Does that make sense?
It does.
So you're taking out a larger loan at the 5% rate, but you're taking that 5% money and you're going to pay off the 10% loan that you took out last year.
Sure, that does make sense. Now, if my husband's already finalized that, do you think that's still an option? I mean,
So
I don't believe that the bill has been paid yet because it's due on the 20th.
it very likely is still an option. And I say that because the limitation to you being able to do this, the only thing that would stop you is if you don't have let's just call it borrowing capacity left for the upcoming academic year. And you're allowed to take more than one loan to reach that cap. And so the only thing that would stop you is if you then ask to borrow so much money for the second loan that the financial aid office had to turn back and say, actually, the amount that you're asking to borrow now, when I sum up the amount of your first loan and your second loan, is higher than your cost of attendance limit. But you can basically move forward as you have right now and still, let's say, check your rates again and try to get a second loan. As long as the rates that you're getting on that second loan are comparable to, let's say, better than what you took your money, that 10% from last year, then you can do exactly what we're talking about.
So just to clarify, it's probably unlikely, even if the bill hasn't been paid, that on the current 5% loan, she can go back to Sally Mae and ask to increase it, because lenders don't really like to increase the loans. They're willing to decrease it. So that loan is probably somewhat set, unless you wanted to completely cancel it and get a new loan in time. But your other suggestion, Chris, is that maybe just look into a second loan and see what rates they can get on the second loan, with the dollar amount to cover whatever is left in their borrowing capacity, and then use that to pay off the 10% loan.
Is there a, yes, it does make sense.
Okay.
Is there a way for us to figure out what the maximum borrowing is there, or is that something that I need to tell, go to the college and ask their financial aid office?
Is if you do you happen to have your student aid or the student bill? Indeed. I don't mean like this second, but if you wanted, you could. The easiest thing would be if you wouldn't mind sharing just what that student bill looks like and the name of the school with me, and I'll just drop my email in the chat. And really, as soon as we get off this, I'm happy to take a quick look at it. And then you just told me how much the first loan amount was for. The math is going to be relatively simple. I should be able to figure that out in about a minute.
Okay, thank you.
Sure thing.
Oh, I had one more question, and I'm sorry I keep hogging up the time.
No,
Both of my daughters are at the same college. One's at a branch, and is staying home this year, living at home this year. But and my understanding in listening to a prior webinar is that even though FAFSA asked that, nothing happens to that information, and that we need to tell the financial aid office that I have two kids in college. Is that correct?
that is correct.
Okay.
Yes. You can, it depends on the school. You should definitely inform them. They may or may not do, they still, even with you telling them, may or may not do anything with the information, but you should give it a try.
And you do it for each school, not because they don't communicate with each other about that.
Now, what are the possibilities there? Just wondering, like, could they offer us additional aid? Is that the intent?
Yes, they could. So maybe the overly simplistic way to think about it right now is the financial aid office is taking the information you did submit on FAFSA, and they're turning that into there's some math that runs in the back end that then says this is a number that represents your level of financial need, and that number that represents that level of need is the student aid index. And then based on that number that they've calculated, they'll allocate different forms of aid to you. When you tell them that there's multiple students in college at the same time, they may ask you for information about how much the cost of attendance is after the scholarships and grants for the other child. And what they have the opportunity to do is to go back and say, okay, let's kind of look at how we calculated that number that says how much effectively aid you need. If the other person is the college for the other student is very expensive, then they may do a little bit more to try to help you. But if your second student, let's say, got a full ride or is going to a very inexpensive school, then it may make no difference at all. So it's just giving them the opportunity to consider how much of an impact the other student's school cost has on your family's finances to determine how much funding you have available to pay for this school.
Okay, thank you.
Sure.
So Chris, there's a question about some of the changes to Parent Plus loans for that, that actually will go into effect in 2026, but how that might impact parents this year, about how they think about whether or not to take out the Parent Plus loan and this idea of grandfathering.
So it's a good question. I see three things I want to touch on here. So I'm going to break up this question and then I'll answer a little bit more directly. So the first question here seems to be, if a parent takes out a Parent Plus loan for the upcoming academic year, and we're going to just posit that if you do that, you're going to be grandfathered into the current version of Parent Plus that does not have the new borrowing limits that are in place for 3 more years. So if you use Parent Plus this year, you get to keep the better version of Parent Plus basically until your student graduates. The first question seems to be, would that grandfathering follow the student into graduate school? And I'd say that the short answer there is no. So that student would then be, if they're starting graduate school in the fall of 2026 or later, there is no way for them to keep the, let's say, better versions of existing federal loans. They'll be faced with new limits starting if they're starting college anytime after July 1st of 2026. There's a second, I'd say maybe the question I'll pull out of this, which is, because the question asks, would a student be able to take out Parent Plus loans for graduate school? And what I'll just say is, for undergrad, there are 2 loan options, and those are different than what graduate students have available to them today. So for undergrad, the student is able to borrow the direct loan, which for their first year of school is typically up to $5,500. And if you need more money after that, from the government at least, you have access to the Parent Plus loan, which allows you to borrow up to the cost of attendance. Graduate students have a different setup, and the parent is not involved. So for grad school, currently, for most program types, the student is able to borrow all the way up to the cost of attendance, and they do it through a mix of 2 different loan programs. The issue for grad students moving forward is that there's something called a Grad Plus program today that helps students attend more expensive programs, and that is going away next year for students who are not already grandfathered into it. And so if you're going to most master's programs as a graduate student, you'll be able to borrow $20,500 from the federal government and no more. And if you're going to law, medicine, dentistry, pharmacy, veterinary medicine, and a few other what are called professional degree programs, they'll be allowed to borrow $50,000 per year from the government and no more. And so as you just think about planning for the future for your children's graduate schools, I would just pay very close attention to that being the key change, because it might impact the schools that you would choose to go to, how hard you try to negotiate your aid offers from those schools. And in many cases, you do have years to plan ahead. So just be aware. Graduate programs are going to have either a $20,500 annual limit or a $50,000 annual limit, and there's really not a way around that. The only, I'd say, way above that is to use private loans like what Juno is typically able to get for graduate students.
Okay. Sean, you said you had a question. Do you want to unmute and share what it is?
Yeah, so let me apologize in advance because I'm kind of back up to very basic questions. This is all new to me
Perfectly fine.
and overwhelming, to be honest, and I consider myself somewhat of a smart guy. So I think, yeah, I had a few questions. One is just to understand what Juno is. So is Juno kind of like I think like a mortgage broker, but is like Juno like kind of like a broker is going to go out and kind of shop these rates, and is my agreement ultimately going to be with the lender directly, or is Juno helping me with that? So I'm just trying to understand Juno. That's my first question.
Yeah,
And
good
sorry,
question.
as a follow-up to that, do you guys work with like the big players like Sally Mae and College Avenue and so forth?
Thanks for the question. So it's fair to think of Juno in some ways like a loan broker. The way that we run our process is you will ultimately be signing a loan with a direct lender at the end of the day, but we make it easier for you to check your rates with a handful of lenders on our site without impacting your credit. What we do is we spend about 9 months of the year with a wait list. That purpose of that wait list is people become Juno members, like they'll join Costco or they join AAA, but they join for free. And when people are joining that wait list, we are able to then go to different lenders and say, look, we have 25,000 people who want loans for the fall of 2025. What's something better that you can do for our group than they could get if they go directly to your own site for your product? And on June 1st, we make the best offers that we've been able to find available to our members. We give them the ability to check their rate without impacting their credit. And the purpose is to just give you an additional tool in your toolkit for thinking about how to pay for college with no cost associated with it. If you don't like what you see and you don't use it, you haven't had a credit check done and there's been no cost. But if you do like it, then you would typically move forward with it. For undergraduate students, the way that we run this process has been our main lending partners for undergrad are Earnest and Brazos. Brazos is a nonprofit-based, Texas-based lender. Earnest covers everybody else nationally. And the reason we've kind of set it up with one national lender for this year in this process is that we've gotten them to agree to a very expansive rate match program. And so if you do right now, about 70% of the time, people end up finding their lowest rate on Juno through Earnest or Brazos. And about 30% of the time, they find a lower rate from College Ave or Sally Mae or somewhere else. And if they find a low rate in those places, we have a very simple process to do a real rate match that I'm happy to walk you through. And on top of that, once we match that lower rate, we're also able to provide you with 3% of the loan amount as a cash bonus. And so the lenders will differ in the rates that they'll offer the same person from week to week, and the same person will get different rates from one lender to another. This process is meant to increase the likelihood that Juno can provide you with the best outcome.
So let me, and I have another kind of separate question, but just as follow up to that, I think this, Debbie, goes back to one of your initial questions, like how are you choosing a lender? And so I think part of that is kind of the repayment terms, for instance, whether I can transfer that debt eventually to my child, so it's not just in my name. So
Yep.
I'm curious how those two players that you just mentioned kind of compare in those spaces.
And those are good things to be comparing lenders on.
They very much are. And so for one of those things, so the repayment terms, there's a couple of things that we filter lenders out. Let's say eligibility criteria to allow lenders to work with our members. And I'd say most of them do meet this bar, by the way, but it's making sure that there's no application fee, no origination fee, and no prepayment penalty. And then making sure that the repayment options are expansive. And really, market standard is to have 4 repayment options. Not everybody does, but I think that's the market standard. where one of the options is also that you don't have to make any payments until 9 months after the student graduates, which I'd say about 40% of people are choosing right now. And on the second question in general, the one I'd say area for improvement and the way that the process is currently set up is that there's not an automatic cosigner release that exists with our main undergraduate lending product or through our partners. So you don't automatically transfer payments over to, or let's say, drop the parent from the loan
I
app.
don't think, Chris, is there any lender who does it automatically?
Not automatically, but
Yeah.
it's framed as being somewhat automatic after 12 months of on-time payments, but then also some basic eligibility check and employment for the students. So some of the cosign releases that are discussed publicly are like marketed. In the fine print, there is still some eligibility required. Like, doesn't have a job, oh, a student's credit is bad or a payment has been missed. The parent's not going to get dropped from the underlying loan. So Earnest is one of our main lending partners on undergrad, and the way they run the process or they view it is you can either do, there's two ways to transfer the payments legally to the student. One is this cosigner release where there are certain terms that are spelled out in your loan agreement on day one. And as long as you meet those, then after a certain period of time, the parent can be removed from the loan. And when that happens, the term stays the same, the interest rate stays the same. The other way to think about it is to refinance the loan at the point of graduation, which would effectively mean I don't know if you're familiar enough with student loan refinancing, but it's similar to refinancing a home, just easier in that there is a new lender that gives you a loan to pay off the existing loan. And you're typically going to do this if you are getting a lower rate. Part of the reason why lower rates are available for refinancing when you're taking out a new loan is because now the student has graduated. And in order to be eligible, they do have a job offer already. So they're just viewed as being fundamentally less risky to lend to. And at that point, the student can take over that co-signed loan, refinance it in their own name, ideally at a lower rate, and the parent is
well, I appreciate all that. I don't want to hog up. So I have a few questions, but I'm going to go to what my original third question, let everybody else have any questions and maybe if it's silent, I'll ask my other questions. But the original question I want to ask, I'm still trying to understand kind of, am I going to get a better rate just, I guess it's a pretty simple question. Am I going to get a better rate just applying in my own name for my student? Or is it going to be the same regardless if I'm a cosigner?
It's a very good question. So it's in many cases, it's going to be very similar, but you'll see that you might have a small benefit to applying as a cosigner instead of applying to a parent-only loan for a somewhat simple reason, and that's just, look, when you do a cosign loan or a parent-only loan, it is the parent's credit and income that is driving the credit decision and the rates. The student typically doesn't have credit history or long enough credit history or income to impact that. But from the lender's point of view, the co-signed loan is still a little bit less risky because in case something happens to the parent, or let's say something happened to their ability or income after graduation, the student is still there to help pay back this loan. Versus the parent-only loan, that's not going to be a thing.
That makes sense. I actually was thinking about the opposite way, but it makes sense. What you're saying makes sense. They just have more people to go after if the
That's
loan
exactly
defaults.
it.
Yeah.
That's exactly it. Yeah. Okay. Anybody else have a question they want to unmute or put in the chat? Okay, so somebody's asking, do you have to stick with the same lender for Parent Plus loans to have the grandfathered benefits, or is it okay to use one lender this year, choose a different lender the following year. Maybe you need to explain a little bit more clearly what grandfathering is.
So let's touch on two things. What is a Parent Plus loan versus what is a private loan to start with? Because I think there's a little bit of potential confusion around the first part of the question is around, do you have to stick with the same lender for Parent Plus loans? And Parent Plus loans are not private loans. They are only and always coming from the Department of Education. You get them by applying on using a link on studentaid.gov. There's not a credit pull, let's say there's not a credit score cutoff in order to qualify. As long as you meet the Department of Education's qualification criteria, everybody gets the same rate. And so if you use the Parent Plus loan last year or this year, next year the process will be the same. You'd fill out a new application on studentaid.gov, and the money will come directly from the government to your school. Everything else that you would use to pay for college, or let's say other types of loans, would typically be private loans. So for undergrad, if you might see this on your student aid bill, you might see this on your school's financial aid website. There are two types of loans that come from the government. One is a Stafford direct loan. The second is this Parent Plus that we're talking about, and everything else is a private loan. The private loans have nothing to do with grandfathering. And so if you end up using a loan from Sallie Mae or College Ave or Ernest or SoFi or somewhere else, I just want to be clear that those don't have any impact or ability to help you grandfather Parent Plus. Now, that being said, I think the second part of the question is, can you use a different lender from one year to the next? And short answer to that is yes. So within a single year, if you wanted, you can stack multiple different loans together. And I'm happy to talk about why it makes sense in some cases. So you could have a Parent Plus loan from the government for some amount and a private loan on top of that. And across years, you absolutely can get a different loan from a different private lender the next year and in your third year and in your fourth year. And I would personally recommend shopping around every single year that you're looking for funding.
And I know it's a lot of work, and I think as what was Stacy said earlier, every year you get a little smarter, and so the process and it goes faster. But I 100% believe and agree with Chris that you should shop around every year.
And I just sorry, I want to, just because you're on that topic of the Parent Plus loan, I'm really struggling with that too, because everything I read online, it says like, absolutely get the Parent Plus loan before you get a private loan. But so I'm curious kind of on your thoughts on that. And then like, listen, the reason, and I'm telling you that I read that, so you're questioning, well, then why are you on this call and why are we talking about private loans? But the reason I'm concerned, I don't want these loans. Like, I have 4 kids about to head into college, and this is going to be a huge amount of money. I can't afford to have all this in my name. I love my kids, but at the end of the day, I need them to be responsible for some of these loans. But I'm just curious because, like I said, the overwhelming things I read says get the Parent Plus loan first.
Can I just
answer that?
I'll just make a comment. I'd be curious. I mean, honestly, at some point, if you want to send me those links, I think what people promote is that students should absolutely be maxing out their federal loans, which are different than the parent loans. So,
Yes.
Okay. I would be surprised, and honestly, I would be like sad to see, a media site like telling you that, because I don't think that that's
Yeah,
the
in
best
fairness, it's not
advice.
me. I'm talking like Reddits. I'm talking about
Oh,
people
okay.
who've gotten the
Okay,
loans
okay.
and the parents of the people who've gotten the
Okay.
loans. Yeah.
Okay. Fair enough.
I can add in that we didn't go with the Parent Plus loan this year because the rate was so much higher.
Yeah. And I am not saying don't go with a Parent Plus loan because, go with a private lender because maybe there's some profit in it or something. I'm saying as a pure consumer, you need to do your research and compare things apples to apples and then make decisions. But Chris, go ahead.
So I think what's interesting to understand about the Parent Plus loan is the ways in which it's different than a private. And the most important thing from my perspective is that the pricing is not market reactive. It's not really competitive. So this year, the price of a Parent Plus loan, the rate is 8.94%, and there's 4.2% origination fee on top of that. And for some people, that ends up being the best rate that's available to them. And for some people, that ends up being significantly more expensive than what the private market can offer them for a loan with a similar structure. So I'm talking about comparing a loan where in the private market, you also don't have to make any payments until after graduation, and you also have a longer duration over which you can pay it off. And the reason why I think it's just that the value of checking your rates is important and shopping around is, and this is regardless of whether you use Juno or not. It's because the way that that 8.94% rate was set up is, in my opinion, silly. It's based on a formula that Congress passed into law without very much thought put into it nearly 15 years ago, that just said, we take the cost of US government borrowing in a certain date in May of each year, and we add 4.6% to that. And that's just a formula that holds true from year after year. And I bet less than 5 Congress people even know or remember how they set that up. Whereas in many other times, the private market is, you have more lenders, they're competing with each other. At certain points in time, the cost of borrowing goes down, their rates go down. Sometimes the opposite happens. So it's just an arcane way to set the price. And because of that, there's often an ability to get a better rate than what is offered.
The other big decision about Parent Plus loan versus private loan, and Sean, you kind of touched on it, is who's responsible. So in the Parent Plus loan, the parent is solely the responsible borrower. And although at some point you might be able to kind of move the money to your child, it's not an easy process, or move the loan to your child. But in a Parent Plus loan, in a private loan, you and your student are on the loan together, and just as everything we just talked about, you can eventually, hopefully, get off the loan, and it will just become your student. So that's also a very big decision about which direction to go. Chris, do you want to talk about there's somebody put a question saying that they are divorced. The ex-spouse was offered a Parent Plus loan. The son is taking out the max in the federal student loans, and they're wondering if, as another parent, if they'll also be able to qualify for a Parent Plus loan, or should they look at private lenders?
I think you can absolutely also apply. So your first step here would be to submit the Parent Plus loan application on studentaid.gov. So that would take you about 15 minutes. And as long as your, let's say, ex has not already signed for, let's just say, accepted a Parent Plus loan for your son's school this year, then your process should be able to move forward. And if I back up for even just a second to help you understand why I even mentioned that, it's wherever you end up getting a loan from, that lender is required to communicate with your school and ask, is the student actually a student here? And is the amount that they're asking to borrow, or that their parent is asking to borrow, below your remaining borrowing limit? Your borrowing limit is the cost of attendance, the sticker price that the school publishes, minus the other loans you've already taken out, and the scholarships and the grants that you've received. And so what you kind of just want to make sure is that here's scenario one is, let's say theoretically that your ex applied for, was approved for, and signed a Parent Plus loan for the upcoming year. Your son is borrowing the $5,500 direct loan. There could be a situation where he's already hit the accept button on his Parent Plus loan. And when you try to complete the process, the school might reach back and say, actually, you're already at your borrowing limit. So that's just the only thing to watch out for. As long as your ex has not hit the sign button, then you should still have the borrowing capacity left. So you would apply today, you'd likely be approved same day or within 3 days, and the process would move forward without an issue.
What if they've already accepted? They've been hit the accept button for the Parent Plus loan, then it might be problematic to get a second PPL.
It could be if there's not borrowing capacity that is left.
Okay.
If there is not borrowing capacity, if you basically just want to switch the Parent Plus loan from one parent to another, then the easiest thing would be to actually just reach out to the financial aid office and tell them that's exactly what you want to do, because they just need to be aware of it so that they can reject the initial Parent Plus and basically log that you still have borrowing capacity left so that they can accept the second Parent Plus from the different parent.
Okay. Thank you.
Sure thing.
I mean, we might have answered this, but I guess we can go over it again. Somebody's asking, do we always assume that the direct federal loans are better than private loans? And they might be referring to the direct federal loans for students.
In my opinion, yes. I often hear questions so let's just maybe give some context here. The direct federal loan is the money that the student is able to get after they fill out FAFSA. So for the first year of school, that's $5,500. For the second year, it's $6,500, and for the third and fourth year, $7,500 each. That is currently set at a 6.39% interest rate plus a roughly 1% origination fee. And so some questions I'll get from folks is, if I qualified for a private loan rate that is lower than that 6.39% cost of the government loan, why shouldn't I just use the private loan? And my answer to that is that the private loan does not have any of the protections that the federal loan for the student does. So even if you can get, in most cases, you will not find a lower private loan rate than the 6.39% rate the student is able to borrow at. And in the rarer cases where you can find a low rate, you should consider that the student's 6.39 is the worst possible rate that they'll end up paying on this loan. If they end up going into certain career paths, they could have that loan forgiven through public service loan forgiveness. And if they are unable to make full payments on a loan, or at least what would be considered the traditional normal payment after graduation, they're able to limit their payment to a modest percentage of their income after they graduate. And one of the even better benefits is, there's not too much that is written about this yet, but there will be. For the money the student is able to borrow from the government, there's a new repayment plan that is going to go into effect towards the second half of next year. And under that repayment plan, it does what I was mentioning. It allows the student to limit their monthly payment to a percentage of their adjusted gross income. And if that required payment is small, and let's say it's smaller than the interest that's accruing that month, then no more interest is going to accrue. So put another way, there's an effective subsidy that has now been passed into law where if you can't make the payment that you need to make your principal amount go down every month, the government is going to pitch in. They're going to stop the interest from spiraling out of control, and they're going to force your principal payment down by at least some very small amount every single month. The end result of that means the 6.39 that you're being quoted on the loan that the student is able to take out is the worst case, and for a lot of people it could be zero or much smaller.
Stacy's just asking, and I think this is from the earlier conversation, just to confirm, are there any penalties for prepaying a loan?
There are not. So I checked this again last week. None of the private lenders that I have any advertising or any from anywhere that I've been able to find have any prepayment penalty or origination fee right now.
So Doreen came on a little late. We did talk about grandfathering, but it's such an important topic this year. I don't know, Chris, if you're willing to just do another quick summary.
And there's actually maybe one or two things we should talk about with respect to grandfathering that folks have not heard yet, unless they are on these webinars. So maybe just to frame this correctly, you can currently use this year a Parent Plus loan, which is money that the parent borrows from the government to pay for their student's college, without where the limit on how much you're allowed to borrow is really whatever you need to pay to the school to complete your student bill. So if the school says you have to pay $50,000 after all of the other funding that you've received, you can use the Parent Plus loan to meet that objective. For anybody who's starting college in the fall of 2026 for the first time, there is just a new limit on Parent Plus loans. So if you're starting college in the fall of 2026, then your parent is allowed to borrow $20,000 per year through Parent Plus and $65,000 over the course of your college education. And so that would be $20,000 for your freshman, junior, this freshman, sophomore, and junior year. Then you only have $5,000 of lending capacity left for your senior year. Right now, there is an opportunity to grandfather yourself and your students into the better version of Parent Plus. And what that means is if you meet the criteria for grandfathering, you just get to keep the higher Parent Plus loan limits, basically until your student finishes college. And there's some, I'd say, negotiated rulemaking that has to happen. The Department of Education has to make some decisions about how exactly they implement this to be on the safe side. In order to be grandfathered, our recommendation is that you make sure that you borrow some Parent Plus loans this year. Even if you find a lower private student loan rate than what Parent Plus is able to offer you, it can still make sense to combine, to take out whatever the minimum amount of Parent Plus loans are for your school, and then take the rest from the cheaper private loan. And just last comment on that, Debbie and I were looking this up and trying to do a bit of research. There is no federal minimum for how much you're able to take in Parent Plus loans. In theory, they would process a $1 loan if you wanted it. However, some schools do have a minimum of $200 per year that we've found published. That $200 just means that's the minimum amount of a Parent Plus loan that they're willing to process. So just keep that in mind. Even if you think that you'll always get a better rate than Parent Plus in the future, it can still be worth it for a very small loan to take out, just to have the peace of mind that you have access to this program for a few more years.
And, I know maybe, in some cases the tuition bill is coming due very soon and you feel like, oh my God, I don't know if I'll have time to do this. You do not have to do it like immediately right now. In this idea of, getting a small amount of a Parent Plus loan just so that you're grandfathered in, you actually have the whole year to do it, as long as you have a Parent Plus loan as of like the end of June 2026. Is that correct, Chris?
Yeah.
So again, don't feel panicked, like I gotta get this done today, but I would do it, in the fall if you can, just to kind of know that you have that Parent Plus loan and you are grandfathered in. If for some reason over the next 4 years you need, more money or than what you or you can't get a good enough rate in the private lenders. Okay. Anyone else have questions you want to put in chat? You want to unmute?
Well, I'm just sorry, going back to oh, sorry, was someone else gonna ask something?
No, no,
No,
no, go ahead.
Okay. Just
Mhm.
going back to I think well, sorry, I applied like 2 months ago to for some lenders, but now it's kind of stale because I just didn't appreciate the timeline. So I do have to go through this process again. And listen, I am very interested in seeing what Juno has to offer, but I'm just trying to understand what the recommendation is. So I go through Juno, but then I just like apply to a handful of other places. So should I like, obviously again, Sally Mae and College Avenue are two big ones. So should I apply to those and Juno? Is there like how many do you suggest I apply to try and just see what's out there?
fantastic question. I just left a link to another website in the chat box. If I were you, I would go to credible.com. So the link is in the chat. And that will let you see what rates are available to you from almost all of the lenders that are not on Juno, also without impacting your credit. And so you can get a very quick check of many lenders at the same time in less than 5 minutes, no impact to your credit. That will let you see, let's say, once you kind of do that, then I would go and make an account on Juno, check your rate, which again, you're able to do in less than 3 or 4 minutes without impacting your credit. And if you, let's say the rate from one of the other lenders that you saw Credible is lower for a term length that you're comfortable with and a repayment option that you're comfortable with, uh, then what you need to do would be to submit an application on both. Like you'd have to submit an application and actually be approved for the loan at those terms from the other lender, and you would just have to be approved for or submit an application and get an approval for any loan through Earnest, and then we'd be able to match that lower rate and give you the 3% cash back. There's some regulatory and compliance reasons why you have to go through and submit the full application on both in order to do so. The one thing I want to say is in your rate shopping experience, one of your goals is to not have to do hard credit checks. When you get to the application period, an important thing to remember is that although a hard credit check does have a small but temporary impact on your credit score, having multiple hard credit checks within a 30 to 45-day window, if you look at both the Experian and TransUnion websites, does not impact your credit score any more than having a single hard credit check, as long as it's for the same product category. Put another way, those products are set up to not punish you for shopping around and putting multiple applications for a student loan, or if you're shopping around for a home for a mortgage when you're doing that. And I just wanted to kind of get ahead of that as a potential risk.
Sean, I'm just curious if you don't mind sharing, what's the age range of your kids?
Yeah.
Just
Yeah, you don't want to know. My oldest is heading off next week, and then so he's 18, and I have three others that are 14, 15, and 17. So
it's
I
tight.
have a lot of loans in the next several years.
Okay, I mean, as I'm sure you know, I would start really planning this out, particularly with the change that just came in place about, how much you'll be able, I mean, these caps on Parent Plus loans. Unfortunately, the only student you're going to be able to grandfather in is your current student.
Yeah. And sorry, just the other thing that I've just been wondering is about the payment option. So would you say that like again, obviously if I had the money, I'd pay it all off now, but is the one that looks kind of the I won't say the smartest, but the most doable and then help is the paying what is it, like paying the interest um well, I forget what they call it, but is that kind of the recommended way to go about it?
Yes, and some just really quick thoughts around it. So you have 4 repayment options that are typically available to you. One of them lets you make no payments until 9 months after graduation. The second one requires $25 a month payments while your student is in school. That one is kind of nice because it typically has lower interest rates than fully deferring your payments. And it also lets you enroll in an auto pay discount. So once you connect your bank account and start making those $25 monthly payments, the rate that you're being charged is reduced by 0.25%. The third option is your interest only, where you're only required to pay off the interest every month until 9 months after graduation. And then the fourth option is a more traditional loan, where it's in the same payment throughout the life of the loan. There's no reduced payment while the student is in school. The way that I would generally think about it is, once you see the rates that are available to you for a given term length, that influences which of those repayment options you would choose for that term length. And the reason I say that is you're always able to pay off a loan faster than what you've committed to, but you can't pay it off more slowly than what you've committed to. So if you end up seeing, okay, I want a 10-year repayment term, and the rate that I'm being charged on the deferred, like fully deferred payment is almost the same as my interest only payment, then it can make sense to just take the fully deferred payment and pay it off earlier. In that case, all you're doing is giving yourself the option of making, let's say, delaying payments, and you can make faster loans whenever you want. Currently, I would expect that you'll probably end up seeing lower rates that are offered to you for an interest only required payment, but that's not always the case. Sometimes I've just seen it be almost the exact same rate across the board.
And if I choose interest only, because I think you have to kind of commit beforehand, right? But can you, and it just becomes unaffordable, like maybe it will when my third kid ends up in college. Is it easy to kind of switch out of the interest only?
It's not, unfortunately. Yeah. So if you chose and the interest only is going to convert to full payments 9 months after graduation. And at that point, if that monthly payment is not affordable, then your only real option is going to be to attempt to refinance that to something with a longer term where the payment is spread. So keeping that in mind, one of the most important things when you are initially taking out a loan is to think about, this is a loan for this year. Let me multiply it by 4, assuming the same thing is going to happen for all 4 years of college for this student. Is the monthly payment that I would have to make after graduation something I would actually be able to afford in that scenario? And that could influence your decision between taking a loan with a 5-year term versus a 15-year term.
But if I do the $25, sorry, this will be the last question. If I do the $25 a month, that is easier to then move. I can afford much more than 25. I can afford like the full interest. It's easier to move that way.
Yes.
Okay.
There's no issue at all. You basically have a servicer. Your loan servicer is basically where you log in and you make payments from, or make payments to, and you would just set a higher automatic payment that would go towards that loan to achieve what you just mentioned.
So if you take the $25 a month interest payment, you've just given yourself more flexibility.
Yeah.
I appreciate it. Thank you.
Sure thing.
So Lisa's asking, we went through this a little bit, but would the rates be lower if she just borrowed as a parent? She did get a rate with her daughter and with her co-signing at 5.2%, which is actually pretty good. Do they have to reapply if they're going to try and get a rate just with a parent?
Thanks for asking, Lisa. I would expect that you applying by yourself would not get a lower rate than the 5.2%. It's a good rate. Yeah. Yeah, that's a very good rate right now.
Anyone else have a question?
I'm curious what are the rates that you're seeing right now for, and I know it obviously depends on credit rating. But for like a good credit rating, which I don't, what I can't remember is good over 720, let's say, but whatever the good.
I can honestly say that the range of expected outcomes is wide and unpredictable, and shopping around is the most important thing to do. And honestly, if you check Credible and Juno, you would see pretty quickly what could be available to you. The reason why I can't give you a clear, if you're at 800 and above, you'd get X, or 750 to 780, you'd get Y, is we're at the period of the year, the really second half of August, when lenders are competing with each other most aggressively. When rates are changing for someone with the same exact profile, from one lender to the next, and one day to the next. I've seen people get 5% rate with one lender on a 15-year term, and an 11% rate with another lender, and then have that almost reverse a week later. And so that's actually why we set up the process the way we do on the Juno side, is to kind of recognize that this behavior and dynamic and competitive economics exists in August. And we just set up a process where we say, don't trust anybody who tells you that the rate that you got is the best rate, just shop around.
And just from, again, from like a business perspective, June, but really July and August are what they call peak loan season. And so this is where, for the undergraduate market, lenders do, what would you say? I mean, definitely 80% of their loans during this season. So as Chris is saying, we're kind of getting a little bit towards the end of that season, and so they're going to compete a little harder to get even more because they know it's a limited time in which they can get as many borrowers as they can.
Oh, you keep walking. It's on that.
Yep.
So two.
Any other questions? Anyone want to put a question in chat or unmute themselves? Okay. Any final advice, Chris? Like I mean, just kind of the example we gave about how lenders are very competitive this time of year. If somebody hasn't closed on their loan, or their loan hasn't dispersed, you want to explain up until the point that somebody could actually change lenders?
So yeah, it's a good question. There's two things worth touching on for changing lenders. So I'd say one, if your loan has not yet, if you signed for a private loan and it's waiting to disperse, meaning that the money hasn't been sent to the school yet, you actually are typically able to cancel that loan until 3 days before that money goes to the school. And that's a fairly automatic process that people do. And one of the reasons why you may consider doing that would be if you did shop around again and realize, oh, wow, I actually got a much lower rate from somewhere else. And so I would still encourage people who maybe even locked something in to at least explore what might be available to you. And to remember that if you have applied for a full year loan and you're at a semester program, half the money that you apply for is sent to the school in the fall, and half the money is sent in the spring. So you may move forward with your loan for the fall, and in December, check your rates again in different places and realize, wow, now rates are much lower. Let me apply for and get approved for a lower rate, cancel my second disbursement, but move forward with this new lower rate. It's something that not very many people do, but that you're able to do. And so just think of it as this entire process it's more confusing than it needs to be, but information is your friend. And maximizing the amount of options that are available to you is the best way to reduce the overall costs.
Okay. And opening up an account at Juno is free. If you have questions, as you're going through the process in these next, final weeks, you can always reach out and continue to get more advice.
Thank you
Okay.
very much, everybody. Thanks, Abby, for hosting.
Absolutely. Good luck to everybody. Please keep us in the loop. I hope things go as well as possible. Take care.